I'd just like to start by saying that Capital Group has a very high regard for you and Jamie Wickham and your Morningstar team altogether. We have great respect for the work you do, and more than that, we actually enjoy working with you as well. So thank you for inviting me. I'm going to start by making 4 propositions and drawing a sort of conclusion from them. And then I want to talk a little bit about how the world is changing and pick 3 or 4 points that we might want to think about. So are these. The next downturn in the economy is likely to have a very destabilizing effect on global stock and bond markets and probably currencies as well. Personally, I'm not pessimistic about government efforts to counteract the next downturn or recession, but those efforts will take place in a very different global strategic and economic environment, and the impact on markets might not be to restore them to the same robust growth path we have had. Third, the traditional levers that central banks and governments will be able to deploy are going to be less powerful and more problematic than we are used to. We need to keep in mind that in the past 10 years, since the financial crisis, asset managers and investors have got used to a very benign market with relatively little volatility and an expectation that if markets get the wobbles of any serious dimension, central banks will come to the rescue. Particularly in the case of Australia, the environment has been even more benign than for most of us in the rest of the world because of steady inflows from superannuation savings and 28 years, I think we're now starting, of steady economic growth. So those 4 unremarkable propositions would lead us to conclude that we need to be more careful than usual to prepare for a situation which is inevitable at some point, maybe in the next year or so. We need to be sure our portfolios are tested to the extent possible against the risks, and we need to understand the changed situation facing the companies in which we invest. So a few points about the strategic environment and how it's changing. Some months ago at the Financial Standards Chief Economist Forum, I mentioned 3 dynamics that are shaping the global order. First, the decline in a pattern of growth driven by successive waves of opening up to flows of trade, then capital, and finally skilled people, which led to a period of accelerating economic integration. Sharing of technology was the latest accelerant of this globalization and economic growth. The second feature has been the destabilizing of a global strategic order that had been maintained by dominant US military and economic power and that favored democratic and free market approaches. The third trend is the wavering confidence in Western political structures and the effectiveness of free markets. We see fractious politics, splintering political parties, weak governments, narrowly focused interest and identity groups proliferating that make it hard for governments to act in the national interest, even where they know what they ought to do. Income and wealth inequality and the low share of wages in GDP add to these difficulties. More intervention, protectionism, and higher taxation are seen as the next resort by many traditionally free market parties. The extended success, prosperity, and stability of this period of 30 or 40 years was enhanced by China's decision under Deng Xiaoping to open up and integrate into the world economy, while at the same time accepting the prevailing global strategic order as being in its interests. This period ended when Xi Jinping came to power, even if it has taken many people some time to understand this. No other country can add the same momentum at the same pace as China has done, not even India, for all its great success and undoubted potential. So in this changed environment, let me pick 4 issues. They're not the only ones, but they're ones which I think we have to think about. What next for the US-China relationship? We've been waiting for a trade deal for a long time. A lot of my colleagues say, well, a trade war makes no sense at all. Surely at some point they'll come to their senses and do a deal. And right now that may look a bit far away, but probably at some point some sort of modus vivendi, if not a deal, will be done. But what we know about any deal is that it won't solve the problem that the pressure put on China was designed to solve, and that is fixing the US trade bilateral deficit. We also know that even if China agrees to buy more products, agricultural products, energy, and so on from the United States, that the key issues that concern the US will not be solved, and those relate to the creation of a level playing field for companies, foreign companies, US companies in particular, with China's state-owned enterprises. These concessions that the United States would like to achieve are simply not going to be acceptable to the current leadership in China. In the case of Huawei, people ask, well, is this a tactical move or not? It's possible that some concessions might be made to allow Huawei people to go on buying Huawei's products and even to sell products to Huawei. But fundamentally, this is actually about the technology part of the strategic competition between China and the US. I pointed out when I was speaking in Sydney a few months ago the big changes that had taken place in the operations of the Committee on Foreign Investment in the US, CFIUS, and the large increase in the number, excuse me, I was going to get some water. The tightening up of the restrictions and the expansion of the restrictions. 4 areas that are particularly involved: critical infrastructure, critical technology, sensitive real estate, and importantly, personal data. And we've already seen these begin to work their way through the system. The Bureau of Industry and Science in the Commerce Department has published a list of technologies, the export of which will be tightly restricted. These haven't been finalized yet, but already we're seeing the impact of this. And we need to understand that this is not just about American companies exporting to China. This will affect any company that uses technology that wishes to export its technology or re-export US technology to China. So this will operate a bit the way financial sanctions have done in the case of Iran. And anyone where we see anyone who's using US dollars who's dealing with Iran is affected. So this is going to have a huge impact on the world trade, on the development of the internet, and is going to remove what was a key accelerant in global growth. In particular, I mentioned Taiwan, and I actually spent a few days in Taiwan a few weeks ago because I was very concerned about the fact that Taiwan is at the intersection of 2 of the features that we now face: the strategic competition between China and the United States and the technology war. The role of Taiwan's IT industry, which is at the leading edge of technology, is crucial. It's very clear in Taiwan that there is a desire to maintain the status quo as a democracy. It's also determined to protect its IP, but it's under enormous pressure. And it's not clear to me that people generally understand the effect on the strategic balance if the status quo were to change. So its political and economic resilience is a vital element in the stability of our region. This is not going to end. People asked me not so long ago whether some deal will be done which will reset the economic relationship between the United States and China. My answer is that, of course, there'll be an ongoing economic relationship between the two. Some modus vivendi will be found, trade will continue, but it will be in the context of areas where there's no go, and it will be limited, and probably the next generation of capital group people will be dealing with the issue. The second point I'd like to cover is China's increasing role in the financial markets. China's keen to play a larger role, and it makes sense. We've seen that the renminbi is part of the special drawing right basket. China's increased, although this has dropped again recently, the amount of trade which is settled in RMB. It's clearly not in a position to serve as a reserve currency, but it makes sense that it wishes to participate, and there's a good response to this from markets. I'll focus on one dimension, the bond market. We can understand why China wants inflows. Its current account surplus is unlikely to stay as large as it has been in the past. There is a huge amount of debt it has to deal with. And of course, Chinese people, when they get money, one of the first things they like to do is diversify outside the Chinese economy. So it makes sense for China to open up its markets. Let's just say, and so it's an enthusiastic participant and a growing participant in bond indexes. Let's say towards the end of 2020, there's around $500 billion, maybe more, in the Chinese bond market. Let's say there's a hiccup for one reason or another. Let's say people don't panic and want to withdraw, but rather want to sell RMB forward on onshore markets. Who will be buying the other side in terms of forwards? How does the Chinese government respond to the implied domestic tightening? Where will the liquidity be? Opening up China's financial markets was encouraged by reformers in China who saw this as helpful to freeing up and transforming China's economy. Is that what the Politburo understood it was doing? What happens in this contradiction between global capital markets and their impact on countries and China's desire to control its economy very tightly? A couple of words on Europe. There are still unresolved contradictions within the Eurozone. The growth paths diverge wildly. There's divergence in competitiveness. I was there with our strategy research group. We divided up and went to 3 European capitals and then met in Berlin to have a look at the future of the Eurozone in 5 to 10 years. What was striking was that people understand the problems very well and sometimes even know the solutions, but the issue is whether they will act in time and in sufficient decisiveness to preempt the problems. We spoke to one of the key advisors to Mr. Salvini. This economist made the point that Italy would not achieve its full economic potential while it didn't have control of its own currency. But he said, we understand that you can't jump out of a plane without a parachute that's flying at 30,000 feet. And so the response from Italy is, how do we get the EU to change its policies and get the EU to be more responsive to handling Italy's debt problem, and how can we encourage domestic growth above all? In Germany, it's quite clear that people understand the problem. There is talk about perhaps the eventual need to move to finalize banking union, to invest a lot more in Italy, to spend more, and also perhaps to envisage fiscal transfers. But the question is, are they ready to act in time to avoid the pressure, the ongoing pressure that this is going to put on the Eurozone, when it's very hard to see Italy, having not grown for 20 years since it joined the Euro, it's very hard to see it growing in the next few years in a sustainable way. The other important point about Europe is that it's going to have to play a larger strategic role just at the point when the UK is leaving. What was striking to me, reflecting on our conversations in Europe, is with all this strategic change, their recognition that they will have to do more for themselves, with Mr. Trump demanding more support from Europe if it is to back it and stay committed to its defense, that actually Europe sees itself becoming less influential in the world, a less important player in the economy. And I just read, just the other day, even from the UK in one of the government's latest strategic outlook, Europe will remain an important actor, but its influence is likely to diminish, and the economic and soft power of the West will reduce. If Europe can't play a key role in the strategic balance, then the Western world, the democratic and free market approaches are going to be much weakened. Final thing I would like to talk about are the options that governments have in responding to the next economic downturn. Central banks, for the most part, don't have the same flexibility that they had to reduce interest rates, some of them already below zero. Parliaments and governments are not going to be that enthusiastic about large increases in quantitative easing because of the effects that has on income and wealth distribution and asset valuations. So that leaves the question of, that leaves the issue to governments in terms of fiscal spending. Apart from New Zealand and Australia, where governments seem to have managed their finances rather better, many countries around the world simply don't have the fiscal space. They have very high debt. They already have large deficits. So that will raise the question of increasing spending and central banks having to help governments manage that by various ways, which boil down to monetizing deficits. A few years ago, this might have been a controversial idea, but I don't think it is any longer. And in conversations in Washington with people who've been in positions in the central bank, it's very clear that this is what people are expecting. What that means is uncertain, but it will certainly have an impact on markets, and it will have an impact on currencies. So those are four things. They're not the only things, but they're four things I think that are worth us thinking about. And what do I conclude from all of that? Well, I don't want to sound as if I'm in a very gloomy state of mind, It's clearly going to give us heartburn as asset managers and investors, but it's not a doomsday scenario. Governments have ways to stabilize economies, but the fact is that we're in a very different world, and this is going to be much more apparent as we come out of the next downturn than it is before we go into it. In our case, in Capital Group, for the past couple of years, we've been watching companies accommodate to these changes. First, as production in China, in many cases, became less competitive and people began to shift, and then as concerns about the dependability of supply chains grew a great deal. So the shifts are already happening, and these shifts are our bread and butter because they are what provide the opportunities and the potential for us to make successful investments. Thank you very much. Onwards and upwards.
You stay there. Okay, so certainly many thought-provoking ideas from Michael there. Now, we'd welcome your questions, so please, if you've got particular questions you'd like us to throw to Michael, please submit those through the app and I'll facilitate those up there. Just to get us started, you sort of touched there on this sort of intersection between monetary and fiscal policy, and you certainly called out Australia as being one place where there probably maybe is some room more on the monetary side. Certainly if you look at markets at the moment that seem to be pricing in rate cuts from the RBA, how should we be thinking about that on the domestic front?
Well, I think the Governor of the Reserve Bank has been saying very clearly that he thinks there's scope for a lot more investment in infrastructure by the government. I assume he means federal and state governments. And he's signaling that he thinks that employment could increase further, and that most other countries have seen unemployment go below what were the expected normal levels, and that there ought to be scope in Australia for that to happen as well. So I don't want to put words in his mouth, but it seems to me that as with other central banks right around the world, ours would probably like to see the government put in some more effort so that the issue is not left to the central bank. And I think the other thing, which is a common feature with all central banks, is that they're concerned about the deflationary expectations getting hold of in the economy. And so my guess is that's the same issue that people need to think about, that the central bank will be thinking about here. So I think there is scope for governments to do more. Generally speaking, I don't know that Australia's sort of a standout in that regard. Obviously, with tax cuts coming, with a huge investment infrastructure program already underway, a very big defence capability increase underway, there are clearly things happening already. I might say I'm very confident about the Australian economy, and talking about the problems with China, my own view is that Australia can manage those somewhat better than, is likely to manage those somewhat better than other countries.
Okay. There's a couple of questions coming through in relation to monetising and government deficits. So, what do you see as the difference between monetising government deficits and quantitative easing?
Well, I'm not sure that I'm the best person to answer that question. But what I would say, we start to get into theory that I'm not really up to discussing. But I think that what's noticeable is that economists are foreseeing a situation where governments do have to increase spending in order to deal with the next downturn. And central banks, because they don't think that the only solution which will work is an interest rate cut, will be looking for governments to to do more by way of fiscal policy, and they will be looking for ways to ease that. So that may be quantitative. You could describe that as quantitative easing, but as to the differences between monetizing deficits and quantitative easing, I'm going to leave that one aside.
Turning to trade then, a number of questions around the whole China-US issue and particularly the political implications of that. How important is the sort of presidential cycle in that, and what is that therefore likely to mean over the next 18 months?
That's a really good question, and it's. I think it's clear that the presidential cycle will have a big impact on the conduct of trade policy towards China. But I think and for example, Mr. Trump presumably has to consider the choice between agreeing to a trade agreement of some sort with China before the next election and perhaps calming the markets, or going into the next election with a dispute continuing and maybe accelerating, given the responses we've seen in the last day or two from China on export of rare earths. The problem that I think he faces is that an agreement which does not reset the terms of engagement with China will be attacked quite aggressively in Washington. The big change that has happened in the past couple of years has been that there is very strong bipartisan concern about China and its behavior and its preparedness to accept the rules of engaging in the global economy. And so the issue here really is not so much reaching an agreement, but whether the agreement is seen as substantial and credible enough to satisfy a very angry Democratic and Republican Party.
So you mentioned Taiwan there. A couple of questions coming through around, what's the likelihood of potential escalation of this trade war to actual conflict?
I think conflict is probably unlikely, but it's a very sensitive issue. The one thing that I don't know how many people go to Taiwan, but I think people who do are always impressed by the astuteness of the Taiwanese people. They wish to maintain their democratic approaches. They wish to maintain a prosperous economy, but they're also very aware that they can't afford to do anything to provoke Chinese concerns. China, I think, wants to avoid military conflict, and so the route it will choose to persuade Taiwan that it ought to join China will be a mix of pressure and inducement. And I think we're likely to see that at work in the lead up to the next elections, which are early next year. My guess is that the pressure will become quite acute, and certainly Taiwanese are very concerned about how they're going to manage that. But I think the key point here is that no one wants a conflict over Taiwan, but I think people in the region need to consider just how important the success of Taiwan is and how much the strategic balance would change if the present status quo was changed.
Okay. So several questions asking back to Australia, how does Australia benefit from this conflict situation currently?
Well, I don't think Australia benefits at all. I mean, I think one of the issues which we need to understand is that, and sometimes it's hard to explain the linkages between strategic stability and our business, But the reality is that just as the dominance of the US and the West in the period since the Second World War and then the collapse of the Soviet Union allowed countries to choose a democratic and free market approach to managing themselves and their economies, if that balance were to change, then the pressure on those approaches will also change. And so that will make our businesses in the longer run look very different. So that's the key for us, and why you see countries in the region being very concerned about China's efforts to increase its influence, and what perhaps we didn't expect would happen if we look back 5 or 10 years ago, that it would start to press its approaches to political and economic management as ones that are preferable for many countries.
Sticking on the domestic front, so you mentioned of Australia and New Zealand being sort of well-managed debt levels at a government level, but clearly at a private domestic level, debt levels are significantly high. A lot of that tied to property lending and whatnot. If we see a sustained weak period in property prices like we seem to have started to see in the last 18 months or so, how does a government deal with the flow-on effects from that?
Well, I think I'm not an expert on Australian economy, but it's just looking from a distance, looks as if the government's already taken measures to ensure that the property market stays viable, and it looks as if the drop in prices is beginning to slow down. And of course, there's the removal of concern about negative gearing and so on, presumably also will have an impact. So I think that looks as if it's sort of under control, and I think the government will be very careful, understanding how crucial the housing market is and the construction industry is to keep that sort of in a happy or relatively viable state. So I don't think that's a huge worry, at least as we're looking at it from the US.
So flipping back to the Northern Hemisphere, you referenced being in Europe, visiting a couple of countries recently. Obviously, the whole Brexit situation, UK politics seems to be in a bit of a mess. We've seen some interesting results out of the European parliamentary elections last week. What should we make of all of that?
Well, it's quite an extraordinary thing to me that the focus of the leadership in the UK and the media in the UK has been totally on the question of negotiations with the EU. Now that's a huge issue, but actually what's probably the most important issue is what does the economy look like in the future, and what does the government want in terms of economic structural change? I mean, this would have been an important point even if Britain were to remain in the EU. But you can't have, any trade negotiator knows that you can't have a successful trade negotiation unless it's in the context of an economic strategy, because that's the point of the trade negotiation. And to my mind, that's the big gap in discussions about Brexit in the UK. And at some point or other, they'll have to come to terms with this. The problem is extreme polarization in the community, and we've just seen that reinforced in the European parliamentary elections. I mean, it's an extremely difficult issue. But one of the things that occurred to me after spending a few days in Europe, again, looking ahead to the future, was the trend in Europe probably is towards a 2-speed, maybe even a 3-speed Europe. This is sometimes raised by leaders. President Macron himself has raised it. And if that's where Europe heads, then the question will end up being asked whether actually Europe shouldn't have tried to accommodate the UK a bit more, especially given that the UK is such an important element in the strategic cohesion of Europe, and especially as it deals with ongoing pressure from Mr. Putin and Russia, and also new challenges from China, which now may have seemed far away, but as I pointed out to one person I was talking to in Berlin, Beijing is actually closer to Berlin than it is to Canberra.
Cool. And so, final question then, turning back to DC, any thoughts you care to share on the new appointment to your former role as Australian Ambassador? Arthur Sinodinos.
Yeah, well, I think it's a terrific appointment. I worked closely with Arthur in Mr. Howard's office, and he's an exceptionally decent man, which is perhaps the most important thing. He's also very, very smart, very thoughtful, and it may be that he doesn't play golf as well as Joe Hockey. However, I think every ambassador in Washington finds his or her own way into having an effect in the system and being able to deliver results. And one of the things about Washington is that people are always looking for ideas and intellectual engagement, and Arthur's got plenty to supply on both fronts, and I'm sure he's going to be very successful. The only thing I personally feel about this is that I regret that he's leaving, because I think he would make a fantastic contribution in Australia, but he'll be a terrific ambassador for us in Washington. It's a very transactional town, but Arthur's got lots of experience in political transactions, so I think he'll do pretty well.
Cool. Okay, we could no doubt chat for hours, but I'm going to have to call it time there. Please join me in thanking Michael Thawley.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.